Hi, welcome to another episode of Money Wisdom. I'm Ralph Dobelli, author of The Art of Thinking Clearly, which discusses thinking errors. I'm here to talk about the information bias. In one of his short stories, the famous writer Jorge Luis Borges describes a special country. In this country, the science of producing maps is so sophisticated that only the most detailed maps will do. Map makers incorporate more and more details in these maps until they produce the map with a scale of 1:1, a map as large as the country itself. Its citizens soon realize that the grand map provides no insight, since it merely duplicates what they already know. Borges' map is an extreme case of the information bias, the delusion that more information guarantees better decisions. Companies listed on the stock market used to publish their financial results once a year. A few decades ago, they switched to quarterly earnings reports. I've asked hundreds of professional investors if having 4 times as much information, going from yearly to quarterly publication, has helped them make better decisions. About 20% say yes, having more data has helped. About 80% say no, it hasn't helped. Then I asked if going from quarterly to monthly reporting would help them make even better decisions. Nobody thought that would help. Continue the thought experiment. How about going from monthly to weekly, from weekly to daily, from daily to hourly, from hourly to by the minute? I doubt that any sane person would think that such an avalanche of information would be beneficial. For now, be glad that listed companies report only every 3 months. But meanwhile, thousands of forecasters, analysts, pundits, commentators, financial journalists and bloggers fill the space with non-stop information about the markets. Many investors constantly absorb this chatter and use it to make decisions. But really, most of it is noise. But we don't just passively absorb this noise. We also actively gather as much information about a stock or a fund as we can before we make an investment. We want to know what the fund's exposure to different sectors is, what its beta is, what others say about it. We do this because we strongly believe more information leads to better investment decisions, which in fact it does not. What's so bad about too much information? Well, it clogs your mind, and it gives you the illusion of knowledge, which makes you overconfident, so you take higher risks. So how can you deal with this information bias as it relates to your investment decisions? Number 1, focus on the facts. Think for yourself. Don't listen to gossip and analysts' reports. They are not relevant. Number 2, beware not only of the information bias, but also of the calculation bias. As the great investor Charlie Munger says, quote, "Everybody overweighs the stuff that can be numbered and doesn't mix in the hard-to-measure stuff that may be more important. People calculate too much and think too little." To sum up, forget trying to amass all that data. Superfluous information is worthless. Don't bother piling it up or counting it. Do your best to get by with the real facts. That's the map that will guide you to making better decisions in the end. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
To watch more videos about making wiser money decisions, click one of these links here.